Matt, talk to me here about our interest rates, specifically our Bank of Canada rate.
Yeah, so we came down to 2.75 as we had a cut. I believe it was in March. Now, when they were talking about the cut, I don't think it was going to happen, but because of the impacts on the tariffs and what could potentially come in April with tariffs, the Bank of Canada decided to make the cut anyways. So they did cut to 2.75. So it'll be interesting to see in the coming months if they continue to cut. It is possible that tariffs can be inflationary. They can also be deflationary, but we'll kind of see how that trickles in the coming months.
Yeah. Okay. And so moving over to actually, I want to talk about this just for a second. When we trace this back to other times we've been hovering around this price, or sorry, this interest rate, you can see that coming into now, we were on the way up in 2005 in terms of those rates going up, but so was our housing market at that time. And it wasn't, coming in a little bit of 07 before the financial crisis, our market was going pretty quick, but nothing like we saw in the years down here when our interest rates were as low as they were. And again, if you look at the chart, like these stretches were just such huge times for the housing market, and we're just not there yet, right? In terms of
we're not there yet. But I also hope that we get into a better range, maybe somewhere where we were between 2018 and 2019, and not go down to the lower bound, because it's those lower bounds that create a lot of speculation in the market, and they drive housing prices to unrealistic valuations.
Yeah, and even through these days where it was ranging from that 2 to 3% in there, this was stable growth. Like if you go back to these years in the Toronto housing market, it was a good time. We were coming out of the 90s. Everything was kind of moving around in a better state there. So it's the issue right now isn't so much that we're at 2.75. It's more about the uncertainty that we're seeing. I know that the Bank of Canada wants to continue to bring this down to help our economy, but at the end of the day, if everything was cruising smoothly and we were status quo, this wouldn't be the worst position for us to be at. So I think we need to move away from that rate mindset so much now, and it's more about the uncertainty that's in the market.
Yeah.
All right, talking about bond yields, we updated this just before we started because we've seen some changes. So jump into it for me, Matt.
Yeah. 2019. So that's a good sign that the fixed rates are starting to break down a little bit further than the variable rates. They typically are a guide, so we should expect variable rates to come down this low as well. So for some buyers, it might be a great time to start talking to your mortgage brokers and ask, is fixed actually the potential better option right now? Because if we do get prolonged tariff activity, it could potentially be inflationary. So you could see the Bank of Canada not cutting the variable rates and potentially having to raise them if things get a little inflationary with the prices increasing. So it might actually be a better option to lock in, but that's a question for your mortgage broker.
Yeah, I think it is a valid part of the discussion. When you think about what fixed rates offer for Canadians and just homeowners in general, they tend to go that way because we're a little bit more risk averse, right? We like knowing what our payments are going to be for the next 5 years. And in a time of uncertainty, I would gravitate that way myself. And the numbers are actually making sense to an extent in comparison. So it's definitely worth that conversation with your mortgage professional. Absolutely. Here's taking a look at Wawa. So Matt, again, we just updated this as it came through there on the 3rd, just last night. It looks like we're getting a cut sooner than we'd expected. So walk me through it.
Yeah. So like I said before, this is, we could potentially see these cuts. So we might get one in, I think that's June.
Yep.
And then one in September, and then one in December. Now, this is assuming that we go into more of a recession, or the economy is weakening. But in the event that we're actually in maybe a stagflationary environment where the cost of things start to increase, and I do have some charts on this later on to kind of show where companies are thinking about their pricing and where wages are going. So if we do start to see some inflationary movement, these aren't as guaranteed or locked in, and we could see these start to adjust hopefully not to the upside, but maybe even less cuts or no cuts. But as of right now, one in June, one in September, and one in December, potentially bringing us down to the 2%.
Yeah, and the direction with this most recent outlook as of April 3rd is they're leaning more into the cuts. Like we weren't, on their last update, we weren't seeing this till October. It was more of like a 70% chance. Now we're at a 99% chance that we're getting that 2.25%. And then it's 50-50 that we actually make it down to 2% by the end of the year, which was nowhere near our radar in December and even in January. So it just goes to show the changes that we're seeing. And of course, according to Wawa, as we take the average across 10 lenders, we are looking at decreases in the fixed rates as well. And that 5-year rate looking much better than we were earlier on.
Yeah, the 5-year fix has fallen below the 5-year variable now, which actually the variable was always above the fix, to be honest.
Yeah.
But to get it down, and you know what? There's 5-year fixes with 3 in front of it. So this is just an average of
Yes.
10 different lenders, but there are lenders out there that can get you a 3 in front of
At the
that
beginning of
5-year.
that number. Yeah, absolutely.